Hello and welcome everyone to the weekly Delphian meeting. Today's agenda, we'll go through market update. Then we'll review some of the earnings that pretty much winding down at this point. And Joe has some charts, in believe Fibonacci levels to take a look at. So let's get started. Okay. We did have one change. SPX still in one, NASDAQ's still in one there, but Russell did pop into 7. So that was, I think, 2 days ago. So we'll take a hard look at that. Another thing, green pie, pretty stable, 39 to 42. So marginally up. Just had a few transitions, and we'll take a look at those here on the market pulse. This is bullish, bearish overall. Not really much movement here in the past couple of weeks. This kind of sideways, like the market did have a little, kind of meandering, but nothing really going on. Overall on this page, let's take a look at the individual states. Sorry, my computer's been a little slow lately. I'm trying to, there we go. Okay, so the states, kind of the same thing as bullish, bearish. The 1s and 8s did have a little pickup in the 7s, but obviously that is going to turn around over the past day or two. Nothing really. 5s are dead. So really just, got a little transitions from, from right here. This is last week. Some of the 8s came to 7, and that was about it. Nothing moving from 7 to 5. So not much movement at all. Overall, the highs, lows, same thing, nothing going on. We'll see if we get any kind of pop here in the next day or so, depending on how the market behaves. Same thing down here, just nothing really moving much overall. So kind of quiet. So, last week we were talking about SPX, see if we can get over that 42. So it tried on this day here. We got up to 42.12. Ended up closing below. Same thing here, at a run above 4,200, and we'll just call that another fail at the 4,200 level here. Had a big move down yesterday, and obviously down again today. So I think we're 40 right above that entry price. So that entry price here is 41.05. So we're right above that. So that's our near-term support. So just call it 4,100. So you can see it's, this whole move, which, we're 33 trading days in. So that's like another 2 weeks left, for the average. Obviously didn't do an average move. That 4,200 pretty much, it's been causing problems, but you can see here, just kind of been bouncing back and forth. This kind of key point. So obviously it's, important level, that 4,100. Here's our big range, 42 all the way down to, 38. So once again, failed there. So really near term, we're looking, can we stay above that entry price? So that's kind of the near term for SPX, but we've been in here quite a while, and not an average move, kind of sideways. Had a few little pops, but never got up, to that target. You can see the high down here, 42.12. We're still like, 37 points away from hitting that first target. But like we've been saying, that 4,200 has been a problem. That level, and failed again. So let's look here. Let me pull this out a little. There we go. Okay, so your level. I didn't pull it all the way back, but you can see 42, and then on the bottom you get this 38. So you see back here, we failed. This was back beginning of February, and just failed again right there on the 4,200. So what are we looking at here? Down 4,100 is that 50-day EMA. So that lines up perfectly with our entry price here, 4,100. So that one's 4,105, but we'll just call it 4,100. So this is going to be critical support here. We like to say in any kind of bullish market that 50 days going to be support on the upside move. So this is going to be a key thing to watch right now, is that 4,100. If it breaks below, obviously the next leg down is at 200, and that's right around 4,000, right below that. So that's our obviously to the upside, 4,200's the ceiling. And downside, we're pretty close to that right now, 4,100. So that's what I'd be watching closely, see if that breaks down or not. And then obviously, way below there's at 3,800. That we're pretty far off from that. So that's SPX. Russell. So that one in the state 7. After a long state 8 here. Got up around 1,800, pretty much the middle of our range. This is kind of acting like it was a top, this state 7 transition. We had a nice spike yesterday up, but, ended up lower. So top of the range, our long-term range is 1,900. So that's our current box that we've been in for a long time, our trading range. So obviously 1,800 area, that's our, see if we can get above that. We're down below that right now. So, the bottom of this trading range is 1,700. That's performed very well, for support. So, I mean, that's the big level to the downside. That's 1,700. So we'll see if I think today, we're 1,765 right now. So, we're still ways off of that, but getting close to the stops here. Obviously, if we continue down, we'll go back into 8 here. We'll have to see SPX, if we can stay below, kind of start trending below that entry price. I would expect it to transition. But, this one's held up well, SPX. Still no market breadth at all. Well, I'm just thinking of that. I'm going to pull up this chart. So this is S&P 500 percentage of stocks outperforming the index. We're currently at 29% outperforming. I guess that's a 50. So this just tells me, I mean, the last time we were down here was, this is .com time frame, 1999. So, it's just, we've been talking about that, no market breadth, and this just kind of solidifies that. Apple's a huge part of the index, and it's been doing well. A couple other symbols, kind of keeping S&P 500 propped up, while like the equal weights and the Russell are down in the dumps in 8, 7, 8. SPX still in 1. same with the, NASDAQ, but, a lot of the outperformers have been in tech recently. So here we are, 7 on average, 2 weeks, typically go into 5 more so, but we'll have to see, 30% chance goes into 8 from here, historically going back to 07. So we'll have to see, if we're doing 5 or, obviously I think the big thing out there right now is, debt ceiling. If they don't get that resolved, I expect, real bad market action.
Say, Josh?
Yep, it did.
Yeah, sorry to interrupt, but
Sure.
where did you, can you tell us where you got the breadth chart that you were looking at? And because it'd be interesting to see how that, the same chart looked for the Russell and the NASDAQ.
I get these from, a lot of these I get from Twitter. I follow, a bunch of people, but you can see down here, the source is FactSet Jeffries. But yeah, I follow a couple, I don't really, I follow my son, his football recruiting, but I also, follow like a real estate guy, like Zero Hedge and, Michael Burry, and then there's a couple more I follow just, for financial news. So, I just kind of scroll through and look for interesting things. And that's where I found this. That's where I found, all this stuff pretty much is just, seeing it on Twitter, and then I just kind of email it to myself and show it to you guys.
Okay, thanks. I've been kind of like wandering through FactSet a little bit, or a lot more lately. But I don't have I don't twit, so, or Twitter, so
yeah.
Thanks.
Yeah, I didn't either until like, my son's like going in his senior year he's getting recruited for football. So I wanted to, a lot of recruiting stuff goes on there. So that's why I started it. And then I'm like, I might as well follow some of these. And then it's actually very useful. It doesn't take a lot of time either. So like I think the key one to follow is like Zero Hedge. I don't know if their website's pretty good. But people that they follow, you'll see their feeds too. So really, if you just follow one, you'll get all the feeds that Zero Hedge, whoever they follow. So that would, you don't have to post or anything, but
Okay, thanks. Thank you.
Yeah, definitely good information out there. A lot of smart people and access to all these charts, and so that's where I get it. Okay, so here's our Russell. Obviously, bottom, I showed you 19 is the top, 17's bottom of our range. I won't even draw lines. We've done this so much, but that 17's held really well. Obviously a little break down here, but came back. So 17's the floor that we have to keep our eye on. We're a little ways off of that. We got up around 18, and that was kind of right around that 200 days, 1819. So you can see we got right up there and kind of failed. The high that day was 1816. So obviously not a good sign. That is failing on the 200. It did get above the 50, so you can use that on the way down by 1780. We're already below that, 1780. So we're below that. So that's one kind of resistance support band I would watch. Obviously, the key is 1700 on the Russell. So okay, go through this. Rates. So we talked about this, like the dislocation, and I'll pull up December, like it pretty much, this whole thing has been shifting. If this from a month ago, this is December, they're factoring in 2 cuts. Before that it was kind of like 3 cuts. So this whole thing is just like shifting. So now December is only factoring in 1 cut from our current level. So that whole dislocation that we talked about, the market expectations and what the Fed's saying, it's kind of riding the ship here, where they're almost factoring in no cuts at the end of the year. And that's a big difference because, I mean, probably like a month ago or so, they were factoring it. We were down here for kind of the average, like 3 cuts. So now we're only down to 1 as kind of like the middle. So market's kind of repricing itself and factoring in, kind of what we had been saying is Fed is not planning on doing cuts. So market's kind of finally waking up to that. Kind of surprising is, right now there are 1/3 chance that we're going to get a hike in June. Totally unnecessary to raise rates any further, in my opinion, from here. But this is kind of where the market is, and it's obviously changed from past couple of months. July, same type of thing, kind of 50-50, whether no hike or a quarter by July. And then you even got a little here for 2 hikes. So big changes. I mean, that was 0% chance a month ago, a week ago, for 2 hikes by July. So now seems like market's kind of pricing in another possible hike here between within the next 2 meetings. And September, same type of thing. So we had talked before, like, okay, we're expecting cuts to start somewhere in here and get down to like 3 cuts by here. Now, pretty much no cuts, maybe 1 by here. So that's a big, market kind of realigning to what's been put out, and at least there's not this huge dislocation between what the Fed's saying and the market expects now, in my opinion. So
Yeah, Dave, again, I have another
yeah, Dave.
question for you there, Josh.
Yeah.
Now I would know, you said the market is now priced in just 1. Now, when you with that statement, I can see the Fed, whoever the Fed's funds betters or those people are. Would you say that they like the major indices have priced in just 1 rate cut or not? Like the
No, not yet.
Yeah, I didn't think so either. So that's kind of why I was making this. Where would you think, whether it's just your opinion or my opinion or whoever wants to comment, where do we think the major indices are with respect to having priced in the right amount of Fed cuts or not cuts?
I think they're pricing them in now, but earnings drive the market. So
Yeah.
so unless something breaks, which we've been talking a lot about, I think everyone in the market's still kind of thinking soft landing, right? Where the Fed's is going to manage this, and the earnings are still coming out fairly well, right? So that's, I think, the current dislocation. Right? So if earnings continue to do well, could it be soft landing? Yeah, possibly. But if rates go up, and banks start failing again, because their balance sheets are disasters. Obviously that would be something breaking more. But the earnings are going to be the driver, obviously. So it's kind of a multi-factor variable equation. Where I think this you know.
Yeah, it always is. I know nobody's, you know, I
Right.
think everybody's agreeing with what you're saying. Nobody would disagree with that.
Yeah.
But, you know, like you say, the market factors in earnings and it's factoring in, it's seeing earnings this quarter and trying to factor in earnings for the next couple quarters. And that's the part that I sometimes have you know, I'm sort of questioning where people are thinking the earnings for Q3 and 4 might be like based upon the earnings of this quarter. So
Yeah. Well, I know a lot, like this was supposed to be like the dwell, like the low end, you know, kind of a contraction, and things really start picking up. So if things don't start really, you know, if the earnings don't, you know, like start match what they're expecting, obviously, you know, we'll have a correction in the market.
yeah, that's what most of the earning calls have, you know, the sentiment on, let's say, my aggregate sentiment that I would apply to the ones that I've listened to are just as you described. They're thinking that this is kind of like the nadir, and you know, things will be better in Q4-ish, but that's I think that's kind of wishful thinking, but you know,
I do
that's
too.
just my opinion. So
I do too. Yeah, that kind of had another kind of recession probability. This is from JP Morgan. So this is, I guess, the like a timeline here. So near-term recession, mild recession, hard landing, that's 24, and then soft landing. So this is their probabilities here, you know, for things happening, and they're, you know, I guess that's like 60% to this. Yeah. So I'm going off this percentages here on the right, not so much the chart here, but so their possibility of a soft landing is 20%. So that's like 1 out of 5. Right. So they're, you know, and their baseline is recession late 23. So that doesn't really match up with like earnings, you know, doing well if we're having a mild recession, you know, at the end of the year. So obviously dislocations, but between, you know, market pricing, if this is kind of, you know, but the earnings aren't reflecting that, right? Joe, have you seen like later
Yeah, Josh,
projections?
you know,
Yeah,
basically, you know, the first 2 quarters were supposed to be down year over year.
right.
And so they were talking about that, you know, earnings recession, as you said, kind of the expected nadir around this period. But I think out to the 4th quarter, especially, it was just under a 9% increase year over year.
Yeah.
So and 3rd quarter was maybe in the neighborhood of, you know, 2% increase, but I think it was, the number I recall is 8.9%, which I think, as Dave said, and you concurred, kind of wishful thinking. That's the last I had seen, and that's got to be at least 2 to 3 weeks old. Haven't seen anything since.
Yeah, so that's, you know, the earnings aren't reflecting this type of, you know, macro research. So, yeah, I guess
I don't know where they came up
that's,
with boil the frog, but that's pretty that's humorous.
yeah. Well, you know, you can't, you know, throw a frog in a boiling pot, you know, it'll jump right out. But if you, you know, gradually raise, you know, the temperature, then it'll stay in there. But you know, boiling, it'll jump right out. So you can't really boil a frog. Like you have to gradually boil it. So anyway, so I thought that was interesting, and you know, it's I guess that's like the dislocation. You know, like the earnings aren't reflecting this kind of macro view right now. So we'll have to see how it pans out. But you know, big picture wise, also, I mean, you know, the Fed is, you know, they're tightening, you know, and rates are high. So, you know, that whole, you know, what they're doing is contracting the economy. So it's like, so that's like the big picture, right? And then, we have to watch the earnings, obviously, but they're, what the Fed's doing is, bearish overall for stocks, so high rates and shrinking the balance sheet. So, and they did, we did get some updates, it was on the 3rd. So that week, the 10th, they pretty much did nothing. Then had a pretty decent drop off, that the following week, the 17th. So getting close down to, where we ran into all our banking problems. Big, we talked about, like, the previous time we had an issue that was a 15% drop. That's down here at 7,500. But we'll see when we get down here if we have any more banking issues. So, but aside from that, really everyone's kind of focused on the debt ceiling right now. So if they fumble that one, it's going to be pretty ugly for the markets, I think. So, only other one is the rates. I mean, fully inverted curve here. So, I mean, the one month 5.5, pretty much all the way, 10 years down to 3.7. And even talk, I like to watch that 10-year, but the 3.5 level, got below, and then it just rocketed up. So that 3.5 is kind of like the magnet so far. But if these rates keep going up, it's going to be bad overall for the banks. Their balance sheets. And so the last time we got up high was back here in March. We got up like 4.1, 4.09 or something like that. And back here we got up to 4.33 in this time frame. So lower highs for the 10-year, but always keep an eye on that. I mean, if this spikes, that'll be problems throughout the economy. So, still, you can get good yield. 1 year at 5%. When's the last, mid decades where people would have killed for that kind of return? Even 2-year 4.3. It can, it's probably matching inflation right now. So, all right, that was it. Market wise, open up to questions, comments.
Yeah, I got one more for you.
Yeah, sure, Dave.
Sorry, I'm the only one that's taking up airtime here, but with regard to liquidity, I was reading an article today from Goldman Sachs about they're projecting that the Treasury Department would have to issue they think that the Treasury is planning on issuing like an extra $1 trillion worth of treasuries after the debt ceiling is resolved, because the debt ceiling gets resolved. So they're anticipating there will be a resolve, and the Treasury is going to have to is going to be issuing a substantial amount of additional treasuries, kind of like when there's a second equity offering by a new startup kind of thing.
Yeah.
And their thinking is that will also dry up a whole bunch more liquidity. Like I think they were saying that they're equivalent to a 1/4 point Fed rate hike, dry up of liquidity for the equities market. I thought that was interesting. It was just out today. So, Goldman's just an opinionator of, they are what they are. And so I thought that was, I don't know whether that's, I don't know what to think about that. I don't know whether that's a good thing.
That's a tough one. Yeah, I'd have to think about that. I mean, if they're, you think of it in terms of supply and demand. If their supply is beefing up, you would think that would
I think they responded,
yeah,
the
drive the
people that were,
rates down.
sorry. But I think the people that I saw responding to that article were say, well, it's one thing to just issue the, but if they buy them, but if they then issue them and then buy them, that would be like QEing, and you know, they were saying that would be bad. So, you know, if one thing is, will that happen? That's one question. And then will they then buy what they just issue and, you know, change the curve that you were just showing on the liquidity curve
Right.
and boost it up again with, you know, they're thinking that's not going to be good. But we'll have to see. I don't know. Like I said, I didn't know what to think about it, but I thought that was you know, kind of like a changing, event changing, or a sentiment changing thing that could change sentiment if it does happen.
Yeah, well, I think, I mean, just trying to think through it a little. I mean, it would probably drive rates up, right? Because they're gonna have to make it, you know, more attractive for people who buy the debt, but so that could spike the rates some, I would think.
Yeah, there's a lot of, I think there's a lot of current discussion on treasuries about which, you know, the you know, 2-year, 10-year, 1-year, you know, that there's a real different effect that the debt ceiling is having on the different, you know, the different time frames. I mean, it's severe. It's not like a peanut butter spread across the same effect over all the different treasury time frames. It's like
Right.
some are really going to, you know, volatility is really going to impact the yield on the shorter ones more than the longer ones. But, you know, since I don't do a lot of treasuries, it's not going to make much difference to me.
Mm-hmm.
It will to the equities markets overall. Okay, thanks. I didn't. I'll
Yeah,
get out.
so I mean, people are gonna seek out, you know, the highest yield for the least amount of risk. I mean, that's like the nature of the markets, right? So if those rates go up, then, you know, more people will be getting, you know, moving money into treasuries or bonds, things like that. That's good point. Let's think about it. Joe, did you have any comments on that?
Not really, Josh. That is, yeah, I really don't.
Okay. All right, we'll just do the quickly go through the earnings. Not much going on other than my computer being slow. All right, come on. There we go. All right. All right. So we got, you know, 3 types of trades open. Bullish runners came back. We still have 1 open, but, you know, didn't make it to 25. Probably did enter day. You know, this has come back some. So we're near break even. You know, overall, I don't think we have any more trades, but you know, this one obviously should close out. Winner, bearish runners, those were up there. So the bearish trades are actually helping us out quite a bit this quarter. So we get 3 active trades, 1 down, 2 up, and all 3 closed out. It's winners. So this one's helping us out. The bearish ones this quarter. And we have 1 non-mover still open. So this one, yeah, we're down a little bit here, but yeah, we got 8 mat. So let's see how this one pans out, but it's up right now. So, but that's about it. Nothing much left with earnings. So any questions on that? All right, that's all I had. Dave, you ready? I mean, sorry, Dave's asking so many questions. I mean, Joe.
Hey, Josh, before I go through the ETFs, maybe you said go through a couple retracements. Hi, everybody. So, I mean, we've had good runs, and because NDX is the most volatile, I thought I'd start with it. As it continued to run, I'm like, geez, how far have we gone versus, the top? So, the chart here goes back to the COVID low. NASDAQ COVID low was, in the neighborhood, below 7 grand. We ran from 7 grand to north of 16 grand. And then we pulled back, and the lows were in October. And the October lows, basically exceeded the 5/8 retracement on the way back down. The only index to do that, we've referred to that over and over, by about 100 points, down around the 10,440 range. So, the rally from October 12, 13, that low at 10.7 has taken us up to a high in the last couple of days at just under 14K. And so went back into the retracements, and let's see, the high the other day was just under 13.9. Okay, 13.9 is just north of a 50% retracement of this down leg. Okay, so we didn't get excessive. Basically, just a little bit north of 50%. 50% is 13,750. 618 was up almost at 14,500. The high, as I said, was just under 13,900. And then the last couple of days, we've had a pretty good sell-off. Last time I looked half hour ago, we're at 13.5. So, essentially a constructive run back up, not exceeding any of the retracement levels. One thing that I did notice in the short term, and just kind of counter trend, but we talk about 5 legs and ABCs. The low out of December, A, B, C, as it turns out, both these legs were symmetrical, and I forget exactly how long, but anyway, taking us up to this 13.9 level was a symmetrical move with this first leg down. So ABC, it looks like we're in some kind of pullback, obviously, over the last couple of days. We'll see what that ceiling, and we've got some pretty good inflation numbers over the next couple of days too, tomorrow and Friday. We'll see what that does to the markets overall. NDX, still state one, but we've reached the number of days at 39. You can see current move versus average move spot on, and look at that target 3 level. So combination of a symmetrical ABC, bigger picture, we're in that 50% to 5/8 retracement, which, as I said, was between 13.7 and 14.5 in the NDX. But Josh often talks about these target levels, and sometimes the stop losses is wonderful targets, and lo and behold, look at it, we've just backed right off at target 3.
Yeah.
That's NDX. SPX, big picture, and going back, NDX, I think rallied about, almost 150% off of the COVID lows. SPX was about 120% of the COVID lows. And then the SPX pullback almost to the money was a 50% pullback. I think the low was 34.91. My number said 35.05 as the 50%, but obviously that's it. So, held there, obviously much stronger than NDX. And, from the recent low, let me shrink this down a little bit, just trying to give perspective there. We have rallied also between 50% and 5/8 on the way back up. You know, Josh has done a hell of a job talking about that 42 level. We ran into that like a brick wall. From a retracement perspective. 4150 was the 50% retracement of the the pullback from the January highs to the October lows. 4150, and then basically 4300 is a 5/8 retracement. So we managed to get through this recent high of 4212 and run, whatever debt ceiling, pick a reason. Just over 4,300 would be the 5/8 retracement. And it's, from a timing perspective, we're about 10 days shy of the average. Really haven't gone anywhere in terms of the move. So, the targets being 4339 is that target 3 would be just above a 50% retracement. So, we'll see what happens. That's SPX on a retracement basis. So, both of them basically, rallying to that 50% to 5/8 range, which was, really what I was after, trying to check out. And Russell, bit of a different story. They're the COVID lows. We had the highs, and then that fake spike high into November of 21, the false breakout. Our pullback in Russell, let me shrink the chart a little bit. The pullback in Russell was, from that COVID rally was similar. It split the difference between a 50% retracement and a 5/8 retracement, on the lows. The thing about Russell, it has led in terms of, extremes. Russell, we got 2 lows. We got the June lows last year, and then just like NASDAQ and SPX, we got the October lows. And, literally, to the same darn point at 1641. And then since then, a little bit of a rally, but what's different a little bit about Russell, again, is the timing of things. And so where SPX and NDX have just made their recent high the last few days, Russell goes back to February 12th. And, Josh has been talking about this since then, just no breath, no breath, no breath. And, I think that speaks to just Russell had that quick run up coming into the first of the year, and it died early February, which was an interim high for NDX and SPX, and has kind of just been languishing ever since. So, in terms of its retracement, it's kind of underperformed the numbers for, SP or NDX, for Russell to the upside are 1950, 2050, and 2150. Back in February, we got up to that just over 2000 level. So, Russell, not a surprise to anybody, is just laying around languishing. There has been some press in the last, before we rolled over in the last day and a half. There's some headlines out there about, the spread between, especially the Russell, I think, and, the Russell stocks. And, that seemed to be shrinking that spread a little bit between SPX and Russell, but, everything over the last couple of days has rolled over. So they're the retracements. Any questions on retracements or? All right, well, then I'll just jump into the ETFs. ETFs, like the market kind of rolled over in the last couple of days. We, last week, basically 5 bullish and 6 bearish with 4 state ones and 2 state eights. Quite a different story this week with just 3 bulls, 2 state ones and 8 bearish, but 5 are in state 8. So I just thought I'd run through the charts just visually real quick. They can take a look. Here are the materials. They've rolled into state aid since last week. No, nothing really jumps out at me at the chart here, except obviously just a little bit of a downward channel there. See if this thing holds over the next couple days, or or not. Few of the things that jump out at me about XLB, and the next one we'll look at are energy. We've just kind of rolled into them. On average, they're a month long, and the typical down move in state aid is 11%. So, probably worth watching to see whether or not we're going to get anything like that, or we're going to get something more like some of the others where we've moved into the states, but there hasn't been any material move. So that's let me just go up here and 5 days here, as I said, down 11%. We haven't moved much yet, but a long way to go if we're going to have an average time period here. Next is energy. Just rolled into 8. Really haven't had an 8 in energy for quite some time. So, I think bears watching as well. As I said, a long way to go. On average, it's 31 days and down 11%. So I think those two, might be worth keeping an eye on for, possible direction of the market going forward, possible leadership to the downside. XLF, nothing new here, really, just kind of sideways. Been in, state aid for 16 days. On average, it's 29. Also looking at down 10%, but I think it's just since we went into state aid, very little movement, just kind of going sideways. 2 more with real estate, which, similar to XLF, just kind of sideways, not much going on there. The difference, a little bit of a difference between real estate and then the next one, utilities. They're not looking for double-digit pullbacks, on average in their state aids. Real estate only 4%, which probably speaks to how strong the real estate market's been for so long, with the exception of the financial crisis and maybe the last 12 months. Because on average, state aid and XLRE is just down under 4%. So sideways there. And then lastly, the utilities, and going back to our homepage on the current UI, you can see, the bonds, basically everything's in state aid. We've vacillated back and forth from bullish states to bearish. They're all in bearish states now, with 3 of the 5 in state aids. And so that's reflected in utilities, which, 5 days ago went into state aid. And on average, those state aid moves, it's a decent move, down 6% when you're talking about, something as static as utilities. So they were the charts I wanted to show you today. Happy to take any questions. If not, Josh, back to you.
Yep. Anyone got questions for Joe or myself before we wrap it up?
No questions, but this is Dave again. I wanted to throw out a shout out and a tip of the hat to Russ. I was remembering back, I don't know, a while back, he was throwing out some ideas about the VIX trades, and with the debt ceiling kind of in discussion mode there, I noticed that the VIX had dipped down into the 16s, and so I said, well, debt ceiling is kind of a volatility event there. Yeah. I think I put on a bull call spread back then, and with a get out number, which is closing in about 50% in about 4 days. It might exit today with half of my number of options there. So anyway, thanks to Russ for volatility. Thinking about volatility, it's an interesting trade during the debt ceiling talks.
Yeah, very good. Yeah, definitely could get a lot more volatile.
I'm thinking.
All right, thanks, Dave. Anyone else? All right, we'll close it up. Thank you all. See you next week.
Thanks, guys.
Bye, everybody.